The 2018 crypto winter. The dawn of 2018 brought a sobering reality for the cryptocurrency world. After the unprecedented highs of the 2017 bull run, the market faced an inevitable correction. Bitcoin and altcoins plummeted, ICOs failed en masse, and the euphoric optimism of the previous year gave way to fear, uncertainty, and doubt, a period that would later be called the crypto winter. The aftermath of mania. Bitcoin's meteoric rise to nearly $20,000 in December 2017 was followed by a sharp decline. January 2018, BTC fell to around $13,000. February 2018, BTC dropped further to $6,000, $7,000 Ethereum, and altcoins experienced even harsher corrections, often losing 80–90% of their 2017 highs. The crash was brutal for investors who had entered at the peak, particularly retail investors drawn in by media hype, ICO promises, and stories of overnight wealth. The ICO collapse. 2017's ICO frenzy had raised billions of dollars, but many projects lacked substance. Poorly executed white papers, unclear roadmaps, scams, and fraudulent teams. By mid-2018, hundreds of ICOs failed or disappeared, leaving investors with worthless tokens. Exchanges delisted many of these tokens, further reducing liquidity. While this was painful, it also served as a natural selection mechanism for the crypto ecosystem. Only projects with real technology, utility, and community support survived. Regulatory crackdown. Governments had been watching cryptocurrency closely, and 2018 marked the beginning of serious regulatory intervention. United States, the SEC began investigating and shutting down fraudulent ICOs, classifying many tokens as unregistered securities. China banned domestic ICOs and restricted cryptocurrency trading, pushing many companies and miners abroad. South Korea and Japan introduced stricter exchange licensing requirements and KYC/AML regulations. While these measures caused short-term panic and market contraction, they also laid the foundation for a more legitimate and secure crypto industry. Exchange failures and security challenges. Crypto winter also exposed ongoing risks in exchanges. Some smaller exchanges collapsed under pressure, unable to handle the downturn. Hacks continued to plague the ecosystem, e.g., Coincheck hack in 2018, $530 million stolen. Users learned that storing funds on exchanges carried inherent risks. This period highlighted the need for professional security practices, insurance, and robust infrastructure, accelerating maturity in the exchange landscape. Market psychology, fear, and capitulation. Crypto winter was defined by psychology as much as economics. FOMO had been replaced by fear. Investors faced heavy losses and portfolio liquidation, panic selling as prices dropped, loss of confidence in projects that had appeared revolutionary during the 2017 boom. The psychological impact cannot be overstated. Many retail investors exited the market entirely, while institutional players observed from the sidelines, waiting for the dust to settle. Survival and consolidation. Despite the downturn, 2018 was not merely a period of failure. It was a time of consolidation and learning. Strong projects with real technology and adoption survived. Exchanges improved, security and compliance communities became more resilient, informed, and cautious. The market began to separate speculative hype from genuine innovation, a process essential for long-term growth. Technological progress amid the winter. Even as prices fell, innovation continued. Ethereum developers worked on scaling solutions, e.g., Plasma and Raiden Network. Bitcoin developers explored Lightning Network to improve transaction speed and cost. DeFi concepts, though not yet mainstream, began to take root in research and early prototypes. Crypto winter was not the end of progress. It was a quiet period of refinement, building infrastructure, protocols, and communities ready for the next growth phase. Cultural and community impact. The crypto winter reinforced the importance of community and education. Investors learned about risks, due diligence, and diversification. Developers focused on solving real technical problems rather than hype. Long-term believers doubled down, creating stronger, more resilient networks. This period strengthened the ecosystem, ensuring that when prices eventually rose, the community would be more knowledgeable and prepared. Lessons from crypto winter volatility is inherent. High potential returns come with extreme risks. Speculation can destroy value. Many ICOs failed because they lacked fundamentals. Regulation shapes legitimacy. Compliance became essential for long-term sustainability. Infrastructure matters. Exchanges, wallets, and security protocols needed to mature. Resilience is key. Projects and communities that survive downturns emerge stronger. The calm before the next surge. By the end of 2018, prices had stabilized. Bitcoin traded between $3,000, $4,000. Ethereum was around $100. Strong altcoins survived. ICOs largely disappeared. The crypto winter, while painful, set the stage for a new era of adoption, institutional interest, and technological innovation. Lessons learned during this period would shape the DeFi revolution, NFT boom, and institutional investment surge in the years to come. Conclusion: from winter to renewal. Crypto winter was a crucible. The market had burned off excess, scams, and hype. The survivors, strong projects, secure exchanges, and informed communities laid the foundation for the next wave of growth. The cryptocurrency ecosystem had matured. Volatility remained, but so did resilience. Innovation continued quietly beneath the surface, waiting for the next trigger to bring the world's attention back to the promise of decentralized finance. The stage was now set for renewed optimism, technological breakthroughs, and the rise of a more mature and global crypto market.